Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Managing Director and Senior Technical Strategist Todd Sohn. Todd, how are you doing today?
Hey Ross, I'm great. Always a pleasure to speak with you.
Yeah, good to talk to you as well. I want to highlight some of the work that you all have done to start out here. We're approaching, I think, the 40th trading day off of the April 8th lows. And you all had kind of put together a list of the big 40-day moves in recent history, what that meant for the market going forward. And I wondered if you could talk about that research a little bit.
Yeah, it's a great question. We always like to look at history to help gauge where a rally or decline sits and what the perhaps path forward is from there. And so we're just about 2 months off of that April 8th market low. And on one hand, we've had really good internal momentum, right? We saw new highs expand pretty sharply over the last week or two. That's a great sign. And number two, when you look at just pure price performance of the S&P 500, the 17 or 18% gain we've had over the last 2 months fits within the top percentile of 40-day percentage changes over the course of the last 70 years. And so what that means is this is among one of the best recoveries we've seen. It's not quite in the, say, the 2009 type recovery zone, but it's still really strong. And what that means historically is you can get some sloppiness in the next, say, month or two, but 3 to 6 months out, even 12 months out, your returns are all strong, very much above average. The only real miss among the data set is 2001. So it's not a perfect indicator, right? But the probabilities lie that equity trends will be higher over the next 6 to 12 months. We like that. We feel confident. It's an unmistakable internal and external breath thrust is the way we would put it.
Yeah, it kind of falls into that momentum tends to beget more momentum in markets, and we've certainly seen momentum in the last couple of months. Sector front, what do you like within the sector and industry space, just kind of writ large? And then the second question would be, can the tech resurgence that we've seen in the last couple of months sustain? I know it was a laggard for quite a while, actually, coming into this month.
Yeah, we continue to like the industrials, and that's global too. We think industrials are very strong, particularly at the defense level. Some of those might be a bit tactically stretched. That's okay. They're still among the best trends globally. We're eyeing some of the capital good machinery type names because those have been a little bit inconsistent for the last year and a half or so. They're starting to reemerge. Financials outside of, say, the private asset managers, which have been a bit lethargic, are still pretty good leadership. Banks are okay, especially up the cap scale, and a lot of the exchange names act very well too. And as for tech, along with the new high data we saw from the S&P 500, tech new high data was really strong as well. So that's the semiconductors finally coming back onto the field. They were the first to correct in 2024. You've now had a really nice recovery from a lot of the semiconductor names. What I like is that flows to tech sector ETFs have really changed course from inflows every single day to more, I would say, just some outflows and some lukewarm positioning there. So that's supportive to me. And also within tech, cybersecurity acts very well. I mean, that's probably a lasting theme given the geopolitical environment, but those are some stocks too that if you're looking away from any sort of AI type plays, take a look at cybersecurity. We are very much fans of that space too.
So from U.S. sector work to international, we saw this big thrust of international outperformance to start the year, some historic kind of outperformance levels. And then the U.S. reasserted itself as we've walked back some of the tariff rhetoric. But this international outperformance has been sticky. I wonder if what you've seen over the last couple of months maybe makes it seem a bit more structural, whether people should really be thinking about those international exposures in their portfolios as a more kind of long-term theme here.
Absolutely. International is contributing to portfolios again. You have the MSCI EFA index making new all-time highs on a durable basis, really for the first time since the mid-2000s. And so we like adding international exposure, particularly because the US still has some concentration problems. Of course, that's worked out great for investors, but if you're nervous about how much tech you might own or how much growth you might own, adding Europe, which now has industrials as the largest weight within some of the indices there, is a nice addition. And then Japan is also hanging in very much so, also very heavy on industrials and consumer technology type stocks. And if you want to go a little bit more into the emerging market space, we've seen Korean stocks also start to perk up well. So we think adding international is sustainable. It should be part of bringing back diversification to portfolios. If you've had low exposure there, increase the dosage. You don't necessarily have to be overweight relative to the US, right? I can understand that, but at least up your international exposure because the diversification is working, because participation in breadth is so strong overseas.
Yeah, absolutely. And the weaker dollar trend seems somewhat durable as well. And that's certainly helping juice international. Todd, thank you so much for the time as always. We'll look forward to talking to you again soon and have a great rest of your week.
Great. Thanks. You too, Ross.